Sorry about that, guys. It's all recording now, which is all good. Right, so the first question I got was, sometimes gold does not play off the MA, the moving average. So how can I sort of enter the trade and how can I be safe when trading from the MA? That can be answered very easily by sort of the method called dollar cost averaging. So usually what I do is when, let's say here, if we're looking for a short, obviously it goes towards the MA and then I'll be sort of looking to short around there. So what I'd do is rather than if I'm trading my smaller can, which I usually start from £100, what I'd do is once it does go to around the MA, I'd put, rather than putting the whole of the 0.05 lot size in at once, I'd go 0.02 lot sizes in around. Sorry, hold on. Around the MA there, rather than going all in at once. Yeah, so as you go 0.2 around there, once it moves either up, then you can start adding more position sizes onto it. So you can go another 0.02. And if it still starts going, the last 0.01. And then usually if it keeps on going above, obviously, the resistance there, in this case, then we just get stopped out because that'd be a stop loss in that case. So that is one way to be safe when trading from the MA. But like we talked about last week, the best way to sort of trade off the MA is to wait for a solid signal downwards if you're going short, or the other way around. If you're going long, then wait for the solid signal upwards. In this case, the solid signal downwards is that candle, where it is quite strong moving downwards. So if you want to go more aggressive into a trade, then I'd go, rather than put in a little bit of your lot sizes in there, wait for that signal downwards, then put your put 0.05 lots if you're using £100 account right there, and then obviously put your stop loss just above that candle. Then it's safe. You're not taking too much risk, and then just let it ride, basically. So that's one way to be safe when trading from the MA, by using dollar cost averaging, when, like we talked about in the previous video. All right. And another one was, what sort of lot sizes should you be using? So a rule a rule I use is, for every £100 I have in my account, to be fairly aggressive into a trade, I'd go 0.05 lot size per £100. So if you're at £100, do 0.05. If you're £200, go 0.01, and so on. So if you're at £300, then 0.15 essentially. So that's another little questions I've had from you guys. And another one, quite a popular one, was, sorry?
Question. I've got a question.
Yeah.
So with your lot size of 0.05, what leverage are you talking about that people have there?
So I use our broker called IC Markets. It's an Australian broker. It's the biggest by volume. I use 500 to 1. So I use quite high leverage. Yeah.
You know, we've got an issue in Australia. They don't allow us to do more than 30 to 1 leverage.
Oh, really?
Yeah, I'm also with IC Markets, but I can't do more than 30 to 1 leverage. So when I hear 0.05, I'm like, what is he talking about?
Yeah. No, I understand. Yeah, that's quite a lot.
So for us to get good money, you need to have a higher leverage. But to get that, you need to show proof that you've got a certain amount of money in your account. And
right.
The other thing is you've been trading consistently for a long time.
Right.
Then it has to go to the government to approve for you to get that lot size.
Right. I see.
Yeah.
So in that case, obviously you'll have to risk more capital, which is the problem.
Correct.
You know, rather than having £100, then you'd have to go close to probably £1,000 to get the 0.05 lot sizes, which is a problem. I mean, I can send me a DM later on. Let's see So there's no way you guys can access IC markets, no?
IC markets have written to them. They've got a series of questions you need to
Right.
pass.
Yeah.
And then for them to approve you. And then the other thing too, you have to show that you've been
Trading for a while. Right.
And some accountant has to sign a form, and then you write an email. So there's a lot of checks for you to get to a higher lot size than 30.81.
Yeah, yeah. So there's about two options for you there. Either have a slightly bigger account, like we talked about.
Yeah.
Or you can go for bigger, like higher pip trades. So rather than going for the sort of like the scalping that I specialize in, like sort of like 5-10 minute trades, rather than that, you'd have to go for bigger moves, like one like there. So for myself, if I took the short there, I'd probably get out of the trade around there. So that won't be a lot of pips, because I try to sort of scalp the market rather than going for us like a swing trade or like a day trade sort of thing. For yourself, you'd have to let the trade run for a little bit longer, essentially. So you'd have to essentially ride the whole move down. But obviously, there is a chance that it could reverse into towards the other direction. So that's the only risk with that.
Because those are the issues I encounter, because I get stopped out a lot. So that's why I was saying, when I look at the moving average, I try to put my stop loss in such a way that probably I might get a good risk reward ratio.
Good risk reward, yeah, absolutely. Yeah, absolutely.
But in the process, we end up screwing off, and then so those are the issues I was having, like how to work around with the with the ride and with this strategy that you've developed to get good results.
So for yourself, I'd say dollar cost averaging might not be the best option. So for yourself, I'd say wait for the big movement down. So like there, wait for the big movement. So that'll be your entry signal right there, and then put your stop loss just above. The last thing you want to do is have a very sort of big, like quite a long stop loss. Then you'd risk losing a lot more money than you sort of anticipate to lose at the start. So I'd say for yourself, wait for the big move down, then enter the trade. Then you're on the safe side. So like if we use an example, that's a big move down. If you enter the trade just around there, the bottom of the end of the candle, put your stop loss just above there. It's not catching up to your stop losses. It's just riding the trend downwards, you know? And it's the same thing just there as well. So you wait for that big move down, enter just about there, and then it's not catching your stop. Obviously, you'd put your stop loss just above the red candle there, and then just ride the trend downwards. Yeah. So rather than going into a trade using dollar cost averaging a lot more, I'd go one sort of like if you're using £100 account, I'd go the lot size that suits you and go heavy into it. And just be careful and just make sure you get your signal downwards first before entering, or else you might get stopped out quite quickly, like you talked about. So yeah, that's what I'd be careful of.
Yeah. Okay.
All right. Does that make sense?
Yeah, it does. I'll give it a try.
Lovely stuff. Yeah, try it, and then I mean, obviously, if it doesn't, if you're struggling with it, just give me a DM, and then I'll be happy to reply to you. That's fine.
Yeah. Okay. Yeah.
All right. Lovely stuff. And then after that, the question is how to use support and resistance along with flip and ride. So again, that'll be sort of like a basic way to draw the support and resistance, and then we'll just use it along with flip and ride. So we can see just around there. Obviously, you can go on a higher time frame just to get more of a solid sort of like support and resistance rather than like a temporary one. Way to do it is just so with here, you're trying to catch as many wicks and candles as you can with a with support and resistance. We do have a video on our channel. It gets into big depths on how to draw support and resistance efficiently. I usually don't draw it on a sort of like a religious basis. I just use it if I really need to. But the simple way to draw support and resistance line is to basically catch as many wicks as you can. So I can just visually, I can see there's quite quite like a support there where it is playing off that quite a lot. There is a couple occasions where it's broken it. So if I just draw that real quick, just around there, catch as many wicks as I can. So there, it's playing off that really nicely. So there, 1, 2, 3, and then obviously on that end, it's acting like a resistance there, and obviously it's acting like support there. Again, like resistance there, but it can sometimes break through it, and then obviously it goes in the other direction. In this case, it broke through it, and then it's playing off it again. But to use support and resistance with flip and ride, you'd have to make sure the MA line is close to the resistance or the support. So in this case, it's fairly close to the support there. So you'd want it to sort of go towards the MA and then move towards the support, place it around there. Obviously, you'd be looking for your entry signals where you have a strong bullish candle, in this case upwards, which we can see just about there. Yeah, so you can see that big bullish candle upwards. So that again would be sort of like a good entry signal. You take the trade just above there, put your stop loss just around there, catch a few pips, 1-to-1 ratio, and then you're done. That's the way I'd use support and resistance with flip and ride. All right. Any questions?
Yeah. Can we use like an automatic support resistance indicator instead of drawing on it too with the flip and ride, or it don't work?
I haven't personally used it. I can have a look for you. Just to double check if it works. I haven't personally used it. I usually just use my own support and resistance. So I just use very, very simple ones as well. Like there, that took me a minute to draw. You know, I can just see a few support and resistances there, and a few candles moving off that. So I'll just pop a little line there, and then as soon as the MA and the support and the resistance or support line gets fairly close, I'd be willing to possibly place a trade if everything else ticks off.
Okay.
But I can have a look for you if you want me to.
All right. Yeah, sure. Because I'm using one right
now.
Yeah. It's pretty good.
It's good. It's working well, is it?
Yeah.
Lovely. Yeah. So I mean, you can have a look for yourself, but just send me the sort of like the name of that indicator, the automatic support and resistance line. I'll have a look, and then I'll let you know within a couple of days.
All right.
That should be no problems. All right. Obviously, you guys have my Discord name as well. So just feel free to pop me a DM anytime, you know, it's absolutely fine. Lovely stuff. So the next question is how to determine the trend for gold. With gold, it likes to wick a lot. It likes to get very false sort of wicks upwards or downwards. That is very common in gold. So the way to actually determine the trend for gold is not by looking at smaller time frames. You always have to look at sort of higher time frames to determine the sort of like the trend for gold efficiently. So in this case, I mean, hourly works fairly well. Like there, you can see it's quite a positive sort of downtrend there. It's playing off the MA quite nicely downwards. But sometimes obviously it can get upwards, and it is playing off that MA quite nicely as well. So hourly is a good way to determine the trend for gold, but I mainly use dailies, just to be completely sure. So again, on the daily, we can see it is on a downtrend at the moment. But again, if I draw another line there, just give me a second. In this case, you can see there is another support line just around there. So what it's looking like to me, again, that didn't take very long at all. That's sort of just visuals. It's very easy to support to draw trend lines. From what I can see there, it's just broken the resistance line there, and it's sort of playing off the resistance line. So for me, from what I can see so far, without doing any analysis, it is looking like could be on a downtrend, gold. But obviously you'd have to take into account all the news, Fed news and everything, because gold is very news sensitive. So you can never be sure just off those trend lines. You have to always look at news, because like we said, he is very news sensitive. All right, that's another easy way to draw a support or sort of like a trend line in this instance. And lastly, another quite popular question is, what's the difference between the smiley face there and the bull and can't actually see any bears. Oh, there we go. And the bear sort of emoji. If we go back to the 5 minutes. Sorry about that. Yes, if we look there, it's very simple. So this essentially flip and ride is based on two indicators. The smiley face is actually the original flip and ride guide we have. So it's based actually on that indicator. Plus Taylor has put another sort of, he says this is a magic formula. He's included that in the smiley face as well. So the smiley faces are the original flip and ride guide, essentially, plus Taylor's formula. And the bull and the bear are just the RSI trend alerts. So like we said, if it's above the RSI 14, if the RSI 14 is about 80 and the RSI 40 is above 50, it'll show the bear bear signal, and it's the other way around with the bull. So if the RSI 14 is approaching about 25 and the RSI 40 is below 50, then it will still give you the bull signals. So it's very simple. From what I have seen in the past, the RSI, the bull and the bear signals can sort of give you too many signals, sometimes false signals. Like in sort of, they're all pretty decent. Like in sort of that instance, you still can get a few pips, but the overall trend there was down. But the smiley faces are more accurate. They don't pop up as much, but when they do, it tends to be a big pip move, and it pops up at the right times, like there. Nice long trend downwards. That's nearly 2,500 pips there. And again, in that instance, that's even longer. Looking at nearly about 3,000 pips there. But also, it's not perfect. So you can sometimes get false signals like there. Obviously, overall trend was downwards, but it took a little bit of time to still move up and then move down. So that's why it's very important to set your stop losses very tight. Not too tight, because then you'll just get stopped out of the trade without even letting the trade sort of breathe a little bit. The stop losses has to be fairly sort of lenient, but can't be too lenient. Then you might risk losing your accounts. Just give it enough room so it can breathe, and then move towards your towards the direction you want it to, essentially. All right. Any questions?
But the indicator can basically work in all time frames, correct?
Sorry?
The indicator can work in all time frames.
From what I have seen, it works the best on M5 because this indicator was built to be more of a scalping indicator rather than
Okay.
determining trends. I have sort of back tested it on H1s. The smiley faces are quite accurate on H1s, but sometimes you can get false signals on with the bull and the bears. So from what I have found on M5, it works the best. That's what I'd recommend. I mean, obviously, if you want to do more of a swing trade or like a day trade, might be worth checking one of our other indicators from Pip Hunter. If you guys want me to, I can make another video with a more of a long term trade one, more of a swing trade. I can do that for you guys if you guys want me to. But Pip flip and ride is mainly just a short term indicator, short term trend setter.
So in terms of a market, which market is it good? Asian, UK, or New York? Or mix?
It works. I mean, again, from what I can see, it works on all of them. Usually in the UK market, you can see like a sort of like a downtrend at the moment. So you could look into the sort of like the selling positions then. But from what I saw, just after the UK market, it moved up straight away. So I'd say all market is working at the moment. But the market conditions are quite tough at the moment from what I can see. It's not the easiest, so that's why all my stop losses are quite tight. You're seeing big movements down and up. Some very volatile times. So I'd just be careful and keep the stop losses again fairly tight, but not too tight where I'm not letting my trades breathe. If that's all makes sense.
Yep.
All right.
Which is better to follow? The bear, the bull, the bear for downtrend. I mean, the bear for downtrend or the happy face or the sad face.
So you get more signals from the bear trends. But I'd say if you see a happy face, I'd go on it quicker. Because the happy face is a little bit more complicated. There's a lot more coding that's gone into the smiley faces. So they tend to be a little bit more accurate. Like there, it's quite a big trend down. Again, there, quite a big trend down. See if I can find another one for you. Again, there, big move down. So I'd say usually for the downtrend, the smiley faces are more accurate. When it does pop up, it gives you quite a big trade. But if you want to scalp, then the bears are better. Because then you can see pretty much you can take a few pips there, quite a few pips there. Again, quite a few pips there. But usually with the bear ones, with the bear signals, I'd go 1-to-1 trades, or maximum 2-to-1 trades, depending on how aggressively it's moving down. With usually the smiley faces, I go 3-to-1 most of the times, because as you can see, the movements are a lot longer. So if you want to be scalping, which I do most of the times, I usually go look at more of the bears rather than the smiley faces. But for long-term trends, look at the smiley faces. Hope that answers it.
In terms of alerts, the smiley faces, bears, and stuff.
Yeah.
What's the timestamp? When you get alert, it will be at the right position on the curve, or it's a few pips later, or
It's a
how
few
does it
pips
work?
later. Usually depending on the quickness of the move, is usually a couple what's it called? Couple candles after it's moved down. So in this case, you'd probably get the signal about there. But as you can see, there's still plenty of sort of movement downwards. So there's plenty of room to make money. It'd pop up with that signal around sort of there after a couple candles. It
Can we
doesn't
use
pop. Go on. Sorry.
other confluences to get in like the short trade so that we don't get false, like let's say a false breakout or anything like that.
Yeah.
Other
So, yeah. So I use with those. I always look at the RSIs. And let's say if we are going short, like let's say there, obviously we can't really see any strong movement down there. So I'd put like on my smaller account, which is £100, I'd go 0.02 there. As soon as I see a slightly stronger move there, I'd put another 0.02 again. But if it doesn't, if it still keeps on moving up, I'd put my last 0.01 lot sizing there. But then you can see strong movement down there. So I'd put my stop loss just above there. So I wouldn't be willing to go any more above that. And the RSI is sort of confirming that. The RSI 40 is above 50, which is again good for a sell signal. And the RSI 14 is very close to sort of like 70 there. So that is nearly overbought, not quite overbought, but nearly overbought. So that is what I'd use, that like dollar cost averaging, just to make sure it doesn't have like a false breakout, for instance. Usually with false breakouts, another thing you can do is on false breakouts, it moves through the MA a lot quicker. So obviously you wouldn't enter a trade as soon as it hits there. You'd wait for the candle to stop. So like you see there, it moved very strongly through the MA. So in this instance, I'd wait for my sell signal, which is a strong bear candle, which is sort of around there. These are not really strong bear candles because it's not moving straight down. It's just like 3 candles. It's not very strong. This one you could argue is fairly strong. But then I'd just use dollar cost averaging in this instance. So it goes 0.02 there. If it moves up, go another 0.02. I'd go probably around there, my last 0.01, and put the stop loss just above it and just let it run. If it moves above that, I don't want to be in the trade because that just infers to me that it's gonna move away from the MA rather than moving towards the MA. But that's the way to be sure. Just be careful. It does not go very aggressively through the MA. If it does go very aggressive through the MA, if the candle goes very aggressive through the MA, then you know there is some strong either bullish signals or bearish signals. So then I'd be a little bit more careful with my money and place my stop losses slightly tighter, just so I don't get that big spike up or down, which takes half my account away, basically. Does that make sense?
Yes, thank you.
Good. Any other questions, guys? Again, this is recorded, so feel free to look back on it. I will upload it on the Flip and Ride channel for everyone else to have a look. And obviously, you're always welcome to message me anytime. If you want to do a live call, just to get a few things under control, just let me know, and then I'll be happy to jump on a call with you. That's fine. But always just feel free to DM me. All right, guys. Thanks a lot. I think that'll be it for today. I don't think there are any other questions. But yeah, happy trading. See you guys later.
Yeah.